Hello, welcome to BST Live. Today we're going to be talking about market regimes and how to potentially improve the performance of your strategies and also reduce the risk by only trading in the best market conditions. Sounds good? Well, let's get to it. Well, welcome to this very first episode of BST Live. Glad you could join us. We've got an excellent topic today and a fantastic guest. Today we're joined by Cesar Alvarez from Alvarez Quant Trading. And you may be familiar with Cesar already. He's been on the show before, but he's a specialist in quant-based trading strategies. He trades a number of different styles, including mean reversion, breakout trading, and trend following. He's very well versed in market regimes. He's got some great stuff to share with us today. So welcome, Cesar. Great to have you here.
Thank you, Andrew. Thank you. I'm honored to be here to be your first guest, this new, better system trader.
Better system trader. That's right. So you're coming to us from Seattle today, I understand, and there's a lot of crazy stuff going on in the world right now. How are you doing over in Seattle? Are you coping? You doing well?
Yes, we've had extra crazy stuff going on here in Seattle. Beyond COVID, thankfully, all my family has been healthy and safe. But over this last week, we even had to deal with fires. The air quality in the Seattle area was the second worst air quality in the world.
Oh my goodness.
We could not leave the house for a week. I thought COVID was bad. Wait till you can't leave your house for a week because the air quality is bad. Thankfully, the rains finally showed up and we can get out of the house the last few days. So things are now at least somewhat better now.
Yeah, we had a similar thing actually late last year in the summer. We had all those bushfires and the air quality was horrible. I think the air actually made it over to New Zealand. It was that bad. So I feel for you, and hopefully that's all going to clear up pretty quickly.
Yeah, it's all cleared up and we're all good now.
Excellent. Now, I'm really excited for our chat today because, we've done quite a few episodes together in the original BST podcast, and some of the stuff that you shared, or a lot of the stuff you shared, actually was really very popular. We had a lot of great feedback. So there was the market regime, the mean reversion series we did, which was, I think, 3 videos in the series about building mean reversion. That was really popular. And then also the stop loss interview we did, you shared 10 levels of stop losses. That was also very popular. So you're always very forthcoming with your research and you give a lot of practical tips and advice. So I think today is possibly going to be also another audience favorite as well. So I'm looking forward to it.
I really hope so. Yeah, I've got some nice little different things here that I don't frequently read about when I'm reading other people's blogs and other research. So hopefully there'll be some things here new for some people.
Yeah, sure. So before we get into the meat of market regimes, perhaps we should do a little bit of background first. So maybe can you explain a little bit about the concept of market regimes and what are the challenges or issues in trading and trading strategies that we're trying to address by looking at market regimes?
Right. So market regimes basically look to see, is there a better time for your strategy to be trading? Let me go, what I'm most known for is mean reversion trading. Now, mean reversion trading does work, when the markets are in a bear market, but the volatility is just hugely increased. And, the volatility is so bad that most people would stop trading such a strategy, or you draw on much worse. So what market regimes try to do is to take you out of positions or prevent you from getting into positions when you're likely not to be, be as profitable. So they're kind of like saying, okay, when is a good time to be in the market? When is it not to be a good time in the market? So that is what they're shooting for. And, doing these market regimes, there are lots of different ways of doing them, but the general concept is trying to reduce the volatility of your strategy while having a minimal impact on your returns. And often they work quite well.
Yeah. So how did you actually discover market regimes? Is there a story behind how that happened?
No, really, it's I used to work for Larry Connors a long time ago over at Connors Research and TradingMarkets.com, and market regimes was just built into him. For him, it was always trading above the 200-day moving average versus trading below the 200-day moving average. So that is where I learned. He ingrained it in all the research that we did. There was always market regimes in that. And then once I went off to my own, I learned 2 different market regimes there. And then when I went off to my own, I also continued doing that and have noticed, in most of my strategies, there is a market regime component. I think there's only, 1 or 2 strategies that I trade in my stable strategies that do not use a market regime component.
Yeah, I actually discovered market regimes in a bit of a painful situation. It was back in 2008. I was trading mean reversion long strategies in the US and the Australian markets. I was using leveraged CFDs as well at the time, and I was doing really well until that financial crisis hit. And I was still trying to buy the dips when the volatility had shot right up. Volatility, I should say, shot right up, and the market was tanking. Stocks were falling. Really, they were almost in free fall at a point there, and I was there buying the dips like it was, so
Right.
I was completely. It was a good strategy, but it was the complete wrong market environment to be doing that, and so that was quite a painful lesson for me. I lost a lot of money in those couple of days, but that's why market regimes is quite dear to my heart, and I think um, it applies to any kind of trader, right? Because it can be. I mean, it doesn't matter what market you trade or what style or time frame, anything like that. I think it's worthwhile to assess the market conditions and make sure that that's a really good opportunity or time to trade your strategies.
Yeah, I mean, I definitely have to agree with that. Is I have market regimes are used on my mean reversion strategies, my breakout strategies, my momentum strategies. Those strategies all have market regimes. They all really reduce market regimes, really reduce the volatility and make them much better. Like I said, the two strategies that I can think off the top of my head that really don't use market regimes. One's a short strategy that I sometimes trade, and that one just does well in both bull and bear markets,
Mm.
or can do well in bull and bear markets. And those are volatility trading strategies. So, but those are just very different strategies. But I think every one of my long strategies have a market regime filter in them.
Yeah, yeah.
Um,
Okay. So I guess then the first part to applying market regimes is you need to be able to classify them, right? So you've already mentioned it, given us a couple of hints when you explained what it was, but what are the types of things you look for when you're trying to classify different market regimes?
Yeah, I mean, there are lots of different ways of measuring market regimes. And like I said, the most popular one being, the 200-day moving average of the, like, let's say the S&P 500 index. When the close is above that, you're in a bull market, and when the close is below it, you're in a bear market. So those are the most common ways. And I'm going to go over a couple other ways that I use it within my strategies and why I actually use multiple market regimes. I think if you trade multiple strategies, it's important to trade also have multiple market regimes in them. So
Mm.
we'll take a look at that a little bit later. But
Yeah.
yeah, I hope that answers your question there.
Yeah, absolutely, it does. So, what about the challenges of classification? So, for example, you just mentioned there the 200-day moving average. Why 200 and not 150 or 250? What kind of challenges do market regimes actually introduce?
Right. Yeah. One of the biggest challenges that it introduces is whipsaw. So you don't want to be
Mm.
getting in and out all the time. And, like I said, why not the 100? Some people really like using the 100, and it can be used. 150 is another popular one. And just what happens is you go in and out more often. And that is a balance because, why not the 250 or the 300? It all becomes a balance. I tend to, like I said, I have a very small subset. And you have to understand, no matter what market regime filter you use, you're going to have whipsaw. It's going to get you out too early or not get you in soon enough. And I'm going to go through examples of that where I show you how three different market regimes sometimes are really out of sync in a sense of how quickly they get you in and out. Sometimes they're
Mm.
surprisingly, even though they're quite different, get you out or in at the same time. So,
Yeah.
that is just one of the downsides of using market regimes. I think people try sometimes too hard to say, oh, okay, maybe if I use the 180-day moving average, that I will avoid the whipsaws. And to me, it's more of a global thing in the sense of you're just trying to avoid the really bad times and don't fret so much about getting it just down perfectly. Even though you can tweak all these parameters all you want.
Yeah, okay. Now, I know you're going to show us some examples on the screen soon of the market regime classifications and some of the things you use. But before we get to that, um, let's talk a little bit about the application, because once you've got these market regime classifications, how do you actually apply that to your trading strategies? How do you integrate it?
Right. So there's two ways of doing this, and my preferred way is I usually will pick a market regime filter ahead of time and say, okay, I'm going to use the 200-day moving average as my market regime filter on the strategy. And then I just build a strategy, whatever it is, around that. And not around it, but just keeping that filter there the entire time. I don't then go back and tweak it and say, okay, what if I did a 180-day? Would that be better? Or what if I did a 250-day? Sometimes I'll start off and say, yeah, okay, maybe I want a 100-day instead because I want something to be a little bit more sensitive. But usually I pick the regime filter, just throw it in there, and then just build my strategy on top of it in a sense. So I'm not trying to optimize that regime filter. I may sometimes try one different parameter. It's like, okay, I got the 200-day. Well, let me just see how it does with the 100-day. And it's like, oh, yeah, it does better, it does worse. I'll just pick that. But there's not a lot of effort to try to get that thing just right. It's like, no, it's a very granular filter. And, so therefore it's like, okay, close enough. That's where I go.
Yeah. Have you ever done it the other way where you've taken a strategy and analyzed the different market regimes to see how the strategy performs in those and then adapting it that way?
The problem I found with trying to do that is strategies usually behave very differently in a bear market versus a bull market.
Yeah.
And when you're trying to optimize your variables, now your variables are trying to optimize for two different markets at the same time. And you end up with like a variable. So let's say you're doing a 2-period RSI sell-off. And, in a bear market, you want the 2-period RSI to be less than 2. In a bull market, you want it to be less than 10. But now when you try to combine them together, it's going to pick some value in the middle, which is not that good for either market. So that's why I usually have that to start with, is like, okay, let me do that. I may go back when I'm done and say, okay, let me just see how this strategy does in a bear market. So I'll just kind of, say, okay, let me just trade the strategy in the bear market and see how it does. Just to see, is it really volatile as expected, or maybe there's a surprise. And like I said, on my short strategy that I have, I thought it would be a bull market only strategy, but then when I said, okay, let me see how it does in a bear market strategy only. And when I said, let me see how it does in bull markets, I found out, wow, it does really well in bull markets also. So that was a case where I ended up taking off the complete market regime filter when I did that little investigation.
Yeah. Okay. Now I know you're going to share some stuff on the screen. You've prepared some examples for us. So should we take a look at that and see how these market regimes are set up and impacting the strategy?
Yes. So let me get my
Just share the screen
going here. All right. Tell me you got my screen up and ready to go.
Got you up. Yep.
All right. So I have a strategy which I call tech comments. It basically is a NASDAQ momentum strategy. So this strategy has a market regime filter. But what I did for this presentation was I'm going to show you how 3 different market regime filters change the results. And surprisingly, actually, how little they change the results in some respects. So our first, my slides here. So our first one is the 200-day moving average. So this basically, the strategy says, okay, I'll go long, only go long positions when I'm above the 200-day moving average. And then if we go below the 200-day moving average, I'm going to exit any of my positions. So you can see here on the far left-hand side, you can see it has a CAR, compound annual growth rate of 26.8%, and the worst drawdown is 31.7. Yeah. So there's one, that's using that way. So that's like another one. So there's a very common one. Everybody knows about this. One that I like a lot is you take the 100-day, what I call the 126-day return on the SPX. Basically, you only go long when the 126-day return is above 0. So, over the last 6 months, has the return on the SPX been positive? Yes, then that means it's a good market. We're in a bull market. Below 0, we're in a bear market. So you can see how this very simple idea gets you very similar results. You get 26.1 CAR and 27.1 drawdown. We'll go over these yearly returns and compare those a little later just to see how it works. So does that method make sense to you, Andrew?
Yeah, absolutely.
Yeah. So now comes one that you probably haven't seen before. This is the 252-day percent rank. So what this idea is, you take the last 252 days closing prices, okay, and then you rank them all, and then you say, as long as my current closing price is in the top half of those 252, I'm in a bull market. If it's in the bottom half, I'm in a bear market. Does that make sense?
Yep.
Okay,
sure does.
So this is a very, very simple one. You're just taking the closing prices and looking. And again, you'll see our CAR and our top drawdown is still very similar. Now, if we compare all 3, you can see that even though these are very different conceptually and actually have very different look-back periods in a sense, because this one's got, we have a 200-day look-back period, a 126-day look-back period, and a 252-day look-back period. We still have very similar results on the CAR, But then if you look at your year-to-year numbers, you can see some dramatic differences. 2008, you can see quite a bit of difference there in your returns.
Yep.
Another year, this year, 2020, you can see two of the strategies are almost identical at 47%, but one of the versions, the Rock 126, has a 28% return this year. Not bad, but severely different. And then there's other years where you're pretty close. 2017, they've got the almost exact same returns. So you can see how, even though the year numbers are different, the global numbers are about the same. So one thing I really like to do is mix up what my strategies use. And the reason being is these don't always get you in and out at the same time. And this is what I'm going to go to next. Unless you have some questions on this chart here.
No, that's good. Keep going, please.
All right.
Yeah.
So, okay, now let's take a look at AmiBroker here. So this is my platform of choice, AmiBroker. This top chart up here is the S&P 500 index. And then you got three bands here. This top green band right here is green when the 200-day moving average, when the close is above the 200-day moving average, and red when it's below it. The middle band is the Rock 126, so the 126-day rate of change. So it's green when the index has been up for the last 6 months, and red when it's been down. And then the bottom green band is the percent rank, so the 252% rank. Again, when it's the top half, it's green, and it's red when it's the bottom half. So does that all make sense there?
Absolutely, yes.
Okay, so now let's take a look at how this recent market sell-off that we had. You can see how the 200-day moving average was one of the first ones to kick off. And, and then this middle one, it took a while for the 126-day return to get you out of the market.
That's interesting.
But you can also see how the 126-day return took you a while to get back in. You can see that while these two, this percent rank one got you in, here and kept you in, basically since about what that is around into May. The percent rank got you in briefly and then got you out again. So you can see how these are different timing getting in and out. And this is why I like to do different things, because you never know when one, let's say the 200-day moving average, will get you in too early or too late. But when you're trading, your strategies are trading a whole bunch of different ones. Well, maybe one strategy is not getting in yet, but another strategy is. So this is kind of why I like to trade a whole bunch of different ones. Now let's look at a different time frame. So if you remember the end of 2018, we had that huge market sell-off.
Yes.
And then the huge bounce. So let's see how these did here. Let's get this on the chart here. So you can see how, again, you can see how their timings are a little bit different on all of these. The rate, the 200-day moving average started getting you out earlier than everybody else. The rate of change got you out briefly, but then let you get back in. So you can see how they're all behaving slightly differently. And even getting back in again after this huge bounce, you can see, the percent rank got you in sooner. About a week and a half later, the 200-day moving average got you in, and this whole rated 126-day rate of change was way late in getting you in.
Yeah. So
you can see how each of these are very different. You may think at this and going, wait a second, this 126-day one doesn't seem very good. Yeah, if we go back to this chart over here, you can see it actually has.
It's pretty good.
Well, it has the worst car slightly, but it has the best drawdown by far. So a worse drawdown case. So it's one of those, okay, it may not get you in right away, but it seems to be saving you some drawdown. So there's, this is again why I like to use the multiple ones. And again, you can also use different parameters. Let's say you don't like the percent rank one at 50%. You can try it at 35% or 30%. Or instead of doing 126-day return, you can do 1 year return or 9 month return. You can try different parameters to see what feels good for you, because all these market timing parameters need to make sense to you and need to feel good to you. Then we'll look at one more. There's another sell-off here. Let's look at the 2008 sell-off. So let's go scroll through this chart here and get myself to 2008. All right. Oop, just went flying by it. Yeah, here's all red. Lots of red bars here. Let's see when they finally got you out. Yeah, here we are, scrolling through. So you can see here in 2008, you can see how each of the ones were slightly trying to get you out early in August. Well, actually, this is end of 2007. You're starting to get you out. And then down here, you can see they're all about triggering about the same time. And then they all finally went red about the same time. But again, you can see the different types of potential whipsaws. And these are whipsaws. These are hard to deal with, especially if you're using them to get you both in and out. Sometimes I just use them to get in, because if you use them to get in and out, you're getting in, and then you're getting out, and then you get in, and then you get out, and this can be really hard. So sometimes I only use them to get in. It depends on the strategy. And then you can see, let's see when they finally got you in. Yep, there's all this red. And then again, you can see how, in this case, actually, the Rock 126 got you in the earliest, or started to get you in the earliest. And they all basically turned firmly in bull market almost the exact same day, which is kind of funny, but interesting. So yeah, so this is how I go about it. This is how I look at it. These parameters aren't set in stone. So it's one of those, find ones that make sense. Maybe 126 days is too short, gets you too many whipsaws, and you want to do, a 9 month. And we can easily see. So let's take a look at this real quickly. So if I change the code, let's go look at the most recent case. So let's take a look at, instead of doing a 6 month return, let's see what a 9 month return looks like. So let me make a couple of changes. So watch this middle green bar, and we'll see how it changes. Oh, look at this.
Wow.
Gets you out quite a bit late, or about the same time, but it gets you in much, much sooner. So yeah, so there's a case. Well, maybe you might think, okay, I don't want to wait 6 months because it gets you whipsaw a little bit too much. So yeah, there's an interesting case. And now let's watch this bottom one. So right now I'm doing a 50% rank. Let's do a 35% rank. I find that value also works quite well. And now you can see, it gets you in a little bit later, but gets you out later, gets you in a little bit earlier. And this market sell-off was so fast and so furious, a bounce so furious, that I definitely would not expect the market timing indicators to get this right. It is just like I said, it just sold off too quickly off of really good. The market was overstretched a little bit, but it was not what I would have said, oh my God, it's about to roll over. So so any questions on that, Andrew, or anybody else actually?
Yeah, we've got a couple of questions in the chat. I just want to ask you a question first. Maybe if you want to stop sharing your screen so we can come back to
All right, let me get to that.
But I found that it was quite interesting, actually, just to see how those different market regimes jump in and out at different times. But generally, they're all pretty close. Have you ever looked at combining them, or maybe having some kind of ranking system to say, if two of them out of three say it's bearish, then have you done anything like that?
Yeah, it's funny you bring that up. Yes, I have. And actually, that is part of for those of you who've gone to my website and seen the market barometer, that is part of my market barometer, where I combine a couple of different market regime filters, and also look at some other, bond data and other things to help, determine whether I believe, to give my gauge in the market barometer thing there. So that is what that's how I use multiple ones.
Yep. Okay, great. I want to ask you about the market barometer in a sec, but I noticed that the market regime examples you shared there were all, they didn't really have any volatility component in it, but you did mention volatility at the start. So how do you actually integrate volatility, or do you not worry about it, or how do you manage that?
I've looked at using like the volatility of either the VIX or the volatility of the SPX as creating a market regime filter. I've not had any success or anything that I've liked and used in any of my strategies to do that. I know some people I like trying to use like the VIX to time the markets, and, tell you when to get in and out. But again, for myself, my own trading, I have not done anything successfully that way. Not to say that you couldn't. Like I said, I know a couple of traders, and actually one just wrote me about a week ago about one he's using. So yeah, there's definitely another potential. There are just so many different ways to do market regime filters.
Yeah. Okay. I've got a couple of questions in the chat here we might cover now. So this first one from Ola. Do you test your regime filter on its own with a buy and hold strategy?
So that's kind of an interesting question. Yes, So I'm not sure exactly what you mean, but here's what I'll often do is my strategy needs to be able to significantly outperform doing buy and hold. So putting the market regime filter on, say, the SPY, and significantly outperform that. So let's say, this tech comment strategy. If I put the market regime filter on it, and if it, for some miracle, it was doing 25% a year, then I would say, okay, my tech comment strategy is not very good because it's not giving me a lot of alpha, or in a sense, or not, I have a much simpler strategy that I could trade and get very similar results. So that, I'm not sure if that's, Olaf, that's what you meant, or whether I just use the market regime filter as a strategy itself that I trade. And the answer to that actually is yes. There's the Rock 126 that I use. I trade it with the SPY. I have a stable of strategies that I trade, and that's one of them that I can potentially trade, is just trading the SPY using the Rock 126. So I'm not sure which of those two questions it was, Ola. Hopefully that answered it. If not, ask your question again, and I'll see if I can get it right the second time.
Okay, great. Thank you. And we've got a question from Suvadeep. My question is how to determine the optimal number of regimes and how to label them using their characteristics.
I can't say there's any optimal, or I've actually tried testing and doing research on the optimal.
Yeah.
Most of my strategies, I would say, like I said, most of my strategies have market regime filters in them, and I probably only duplicate each of them maybe once or twice. And I actually have some that I haven't even discussed here that I've tried before, and it's like, yeah, this is interesting, but I've not done to other strategies. So I'm probably trading 5, 6 different market regime filters. Or it could be these with slightly different parameters. So instead of using the 200-day moving average, maybe I'm using the 150-day moving average. But I've not done a systematic approach to it in a sense of, okay, mostly because, like I said, these are broad stroke things. So what I'm looking for is just tell me when I should be in or out. I'm not trying to make them perfect. They're not the thing I'm tweaking in my strategies. Like, they're not the knob I'm trying to get perfect. They're just a big brush stroke that's like, okay, good enough. Yeah, it sort of works. Perfect. Like, I get my strategy, the important stuff, parts of my strategy working. When do I want to take the breakout? Where do I want to put my stop losses or my profit targets and things like that?
Yeah. Okay. Another question here, or a question here from Joaquim. What about using the market filter as signals themselves? So I guess he's talking about going long and short on the index, perhaps.
I'm not sure if you're saying, hey, I've got 4 market timing indicators and 3 of them are selling stuff, are saying fair market, go ahead and get out. That's kind of how my barometer works on my website. In some respect, but I like to have, like I said, I like to have different market regime filters for each strategy because they're not perfect, and some of them will get you out too early, some of them will get you out late, some will get you in too early, some will get you out late. And between all that, this way, at least for me, for the way psychologically, it feels good. Sometimes it's like, oh my God, why am on the bounce? When that bounce happened, a lot of us were in cash because our market regime filters took us out. But depending on your market regime filter, you may have missed a huge portion of that bounce. Yeah, some of my strategies missed a big portion of that bounce, but some of my strategies got in early, and I got to enjoy that bounce, and that takeoff. So it was like, at least I wasn't missing all of it. And that's kind of why I trade a whole bunch of different ones and don't use one to globally affect everybody.
Yeah. Here's another question from Ola. This is a good one, actually. This talks about exits, which we haven't really talked much about yet. But Ola would like to know, do you ever use regime filters to exit your entire portfolio?
Yes, so I definitely always test having a market regime filter not to get into new trades. That's always there. And then I will test separately, do I want to get out when the market goes negative? Now, what I've in general found is the longer the holding the strategy, the more often I usually want to get out when the market goes negative, or goes into a bear market. So, but it is definitely something I test with and without on the exits. The tech comment strategy that I just shared uses that market regime filter to get me out and says, oh, nope, bad market, get out your stocks. Just because, when you're trading NASDAQ 100 stocks, when the market goes down, it goes down quick. And you're trading with these momentum stocks, you just want to get out of them because you just never know how quickly they're going to go down.
Yeah, yeah. We got a question from Nunez on the current markets, which we're going to get to in a sec when we talk about market barometers. So we'll come back to that one. But another question from Ola. Ola's got lots of good questions today. Good job, Ola.
Oh, that's okay. Ola's good. I know Ola, so I always like his questions.
Okay, excellent. So do you see market breadth indicators as being useful as regime filters?
I have tried like crazy to get market breadth to work. I have not been able to get a market breadth indicator to work. I would love to, but like I said, I've not managed to get it to work for my strategies at all. I've tried so many different ways. I've read so many things. I'll read something in a blog post or stocks and commodities or just this. It's like, oh, this is the market breadth indicator that will work. And I just have not been able to get one to work. I understand. I'm not looking for perfection. I'm just looking for something that works roughly as good as something else. It doesn't make my strategy go, doesn't take my tech comment strategy, which is making 26% a year, and also it's making 19% a year. Unless it really reduces the drawdown dramatically too. But usually, like I said, it usually reduces both dramatically or just makes things worse. So I've not had any success. I've tried hard out there though.
I guess that's one of the contradictions of trading, right? Something that seems so logical that would work awesome. It doesn't mean it is going to work. So
I know. You got to test it. That's why I always, when people come to me, it's like, oh, will this idea work? And I'll tell them, look, I'm right half the time, I'm wrong half the time. You got to test it, because I can't tell you how often I go, oh yeah, that'll work, and it won't work, or there's no chance that's going to work. And it's like, oh my God, I've got a perfect trading strategy.
Yeah. A question from M. Nunez. Is this a top-down strategy that eventually gets you involved into an individual stock or sector?
I would classify this as not even top-down or even bottom-up. It is just a fundamental part of the strategy, in the sense of when, like I said, most long strategies only do well in bull markets. So for me, it's like, okay, I'm going to use the Rock 126 on this strategy, and that's just a core rule. I'm not even going to, I'm not going to change it and anything like that. And then I start building, okay, I'm looking at breakouts. Do I want to do a 52-week breakout, a 26-week breakout? Am I looking for high volatility stocks? And I build off it that way. So it's not something I kind of add at the end, or it's kind of added right at the beginning for me.
Yeah, sure. A question here from Horo. Do you use oscillators as well as the simple indicators shown as part of your market regime flags?
Not sure by what you mean by oscillators. If you're making something like MACD or anything like that, or I guess a long-term RSI, you could. There are just so many different ways of doing it. I will not claim to have tested all of them. I have not tried any oscillators. I haven't tried using like a long period RSI or anything like that. Well, not that I can remember. I've tested so many things, I've probably forgotten half of them. But not like I said, that is definitely a possibility.
I guess if you think about
one thing I want to be clear.
Oh, sorry, go on.
Ahead.
No, you go.
Yeah, one thing I want to be clear is, don't look for perfection on these market timing indicators. They're just broad brushes to get you in and out. And yeah, there are so many different ways of doing it. And my thing is, especially if you're testing something new, and when I'm testing something new, I compare it. Okay, is it better? How much better is it, or worse than my 200-day moving average or my Rock 126 one? That's kind of that's my gauge. Is like, okay, let me take my tech comments. So your oscillator idea, I take your oscillator idea, I put it into my tech comments strategy, and say, okay, does it make it better or worse or about the same? Even if it's about the same, then I know, hey, this is a good market timing indicator that I can then use on some other strategy.
Yeah. I just wanted to add a little bit to that oscillator question. I guess if you think about what the percent rank is doing and what an oscillator does, an oscillator typically wants to find the position over a previous range, right? So I guess maybe indirectly you could say the way you're using percent rank perhaps is an oscillator.
Yes. Yeah, that's true.
Yeah.
Yeah, because it is going to be going up and down kind of thing like that.
Yeah. I love the main point you mentioned there about just keeping it simple. I think that's a pretty important topic here, not to try and get it exactly precise.
Yeah, I mean, and at the end of the day, I like things simple. I'm a simple guy, so it's like, okay, I don't like big complicated systems, big complicated rules. Yeah, I can do those things, but I find they usually break or don't work, or I stop trading them just because I don't like them that way.
Yeah. Now I want to move on to market barometer. Someone did ask about that, and the chat's moving too quick, so I've missed the name. Sorry about that. But you do have a market barometer on your website, which seems to integrate some of this market regime stuff inside the calculation there, and perhaps even a combination of them. So, can you talk a little bit about your market barometer?
Yeah, I mean, I was looking for kind of just a general gauge to understand, because the currently with like the market regimes, it's just bull or bear. Is it good or is it bad? So the market barometer for me was a way kind of to get a better feel. Not that I do a lot of discretionary trading, but just to get a better feel. How's the market? I wanted to just quantify the market in a little bit more slots. And the way I built that was using a couple of different market regime filters. I use some bond data, so some bond data telling me what's going on. It's not meant to be kind of like a system to trade to say, hey, it says it's a bull market, I'm going to trade the SPY now. Oh, it says it's a bear market, okay, I'm going to short the SPY, whatever. It's more, because it's also longer term. It's looking out 3 months, kind of saying, okay, if the market is, if we go into a bull market, also, how the market is expected over the next 3 months.
Yeah.
So, it's not, that is a very different look. You wouldn't use that for a mean reversion strategy that gets in and out in a week. That doesn't give you the kind of general scope of things.
Yeah.
But I am right now developing a new, I guess, market timing, kind of very similar to the market barometer, but for trading. I'm developing a strategy right now where I trade the SPY and the TLT, and using that information, using market regimes and other bond data and other data to say, okay, when to be long the SPY, when to be TLT, and it builds off the concepts from the market barometer.
Yeah. It's interesting actually that you just mentioned that you're trying to look at what's going to happen potentially in the next 3 months, and you can often, when you're looking at these market regimes, you notice patterns. There are patterns in the transition, say, for example, from a quiet bull market to a rip-roaring bear market. There's usually volatility changes and sideways markets and things. Have you done any work in using the transitions to perhaps give you a heads up that maybe you need to start switching your strategies or the way you approach trading in the future?
Well, something in the market barometer. So let me share my screen again, if it's all right.
Sure.
So this will show you. Let me see. So you'll see. Okay, so you can see how let's take a look at this bottom chart down here is the market barometer, and it's basically got 4 ratings. So there's red for the bearish, and bearish usually means that the markets are expected to be down on average over the next 3 months. There's the neutral. They're bullish and very bullish. You will notice how right here we go from bearish to neutral, and we jump straight to very bullish. So at the beginning of a move is usually the most bullish time. So to me, this green section is usually a really good sign when this happens. And then after a while, your very bullish becomes just regular bullish in a sense. So I don't know if that answers your question, but that's kind of conceptually when you're moving through that transition. You'll notice how sometimes this market barometer will change from just neutral to very straight to very bullish.
Yeah. That does help. You just want to stop sharing your screen so we can talk. I've got a question for you actually about strategy failure.
That's always a popular topic. That's a 3-hour call. That's the next one for us. We got to allocate 3 hours for that one.
I want to ask about it in the context of market regimes, though, so I'm going to try and narrow it down so that we can keep focused on the topic. But I think one of the common assumptions when strategies fail is that the market conditions have changed and the strategy isn't suited for that. Now, do you have any research? Have you noticed anything that kind of indicates that is truly the cause of strategy failure, or what can you share about that?
I believe that is one possible cause. I've had strategies that I've traded that were doing great and then just suddenly fell off a cliff. And and I never understood what in the market suddenly made it fall off the cliff. But something must have changed in the market. The hard part is you can't know whether the strategy actually is, when a strategy dies, you just don't know. There's just so many other reasons. Is it the current market environment just not good for it? Are the markets does the strategy just no longer work? There's just so many other things that you can't know until in a sense, a year or 2 or 3 or 4 or 5 years after, where it's whether did it die, did it just go on a hiatus, or what? And I've got my own ways of dealing with that now that I'm most comfortable with.
Yeah. So do you think that the implementation of market regimes actually reduces the instance of that, or the chance that that may occur because the markets have changed, or is it completely different?
No, I don't think I don't think having the market regime filter helps you at all on that, because this strategy that I talked to you that died. The markets, it was a mean reversion strategy. Markets were above the 200-day moving average, and there was nothing obvious to me from a it's like whether the volatility of the market or anything like that really changed. It just simply just stopped working. I mean, it was really odd. I mean, it's really funny. I looked like a year later after I stopped trading, I went back and looked at the monthly returns. It was very clear. It's like, oh my God, something dramatically changed, and it was I never figured out kind of what, or kind of made up a story for it.
Yeah. Okay, I got a question here from M. Nunez. Do you also go short when the market regime goes bearish?
So no, I mean, in the sense of, unless I have a short strategy, that is its rule, in the sense it goes short when the markets are in a bear. I don't do that. Like I said, I have one short strategy that is in my stable of strategies that I trade, and for that short strategy, it has turned out that it's good to trade at any time. Bear markets, bull markets, actually it does better in bull markets than it does in bear markets, surprisingly. So for me, for at least for my thing, so like my tech comment strategy that I just went over, it doesn't have a short component. Markets go bearish, I just get out, I'm in cash, or cash equivalents or something like that. So no.
Okay. And a question here from Nitin. What is your opinion on walk forward optimization?
I don't do it. Let me just say, it's not that I don't believe. Well, I guess I don't believe in it if I don't do it. I just don't do it. My preferred method of testing, or determining whether a strategy is good or not, is using parameter sensitivity testing, and both in sample and out of sample testing. That's just what I do. Like I said, that is a whole other 45-minute to an hour conversation of why I pick what I do. Hopefully, at least that just gives you a little idea of what, I just don't do it that way. I do something else that fits me, that I believe in a little bit better.
Yeah. I think we actually discussed that in length in one of our very first podcast discussions way back in 5 years ago. So Nitin, you should go and check. I think it was like episode 3 or 4 or something like that of the BST
I think
podcast.
you're right. I think we did discuss
talk
that
about
in one of our episodes.
Yeah.
But it's also possible that my thoughts on that have changed, because I'm not sure exactly where when I came into this whole parameter sensitivity testing and this in sample out sample. So I'm flexible. It's like I can tell you things have changed from what I thought 5 years ago and 10 years ago. So
No, I do remember actually. I don't think you didn't do walk forward back then, and we did talk about in sample out of sample a little bit, but you didn't mention parameter testing, sensitivity testing. So that might be something new that you've been doing over the last few years.
Yeah.
Okay, we got a question here from Adam. Let me just post it here on the screen. For very short-term strategies, day trading or swing, what is your opinion on day of week regimes or biases? For example, no entries on a Monday, Tuesday, etc. What a great question.
Oh, that is a great question. I have not. I mean, I've actually done research on this when I was working for Larry Connors 10, 15 years ago, where we definitely saw a strong bias on certain days to be in the markets. I have honestly not done anything that recently. It would be very interesting, especially if you're doing day trading, to see are there particular days that are better. I would not be surprised, especially Mondays and Fridays. I think one of those days is going to suck, and one of those days is probably going to be good. At least that's what I've generally seen. But no, I haven't done anything recently. It would be, if I was a day trader, I would definitely be looking into that to see if there is a strong correlation between the day of the week and my profits.
Yeah. I know Adam trades futures, so you do in some futures markets. There's definitely daily biases that occur for a while, so definitely worthwhile checking, I think. Got a question here from Baby Panda. Good question, actually. Welcome, Baby Panda. He's just joined. Sorry, I just came here. That's okay. How do you identify between switching from mean reverting or breakout versus both running simultaneously on the same instrument?
Personally, for my own trading, I run them simultaneously.
Yeah.
I can't remember the last time I actually had a signal on my mean reversion strategy and my breakout strategy at the same time. I just run them at the same time. I think trying to figure out when is a good regime for breakout or when a good regime for trend following is, I haven't had any success in that. And like I said, I use my general market regime filter. That gets me in and out when in general for each of those strategies, and that I've had more success with.
Okay. We've got a question here from Joaquim. It's kind of a regime question, but not using the market, but rather the performance of the strategy. Regarding
this is back to
this is another topic
when a
all on its
strategy is
own.
broken.
Sorry?
Yeah. This is back to when is a strategy broken?
Yeah. Have you tried adding a moving average to the strategy equity curve, I guess, as a way to switch it on and off rather than using the market?
Yes. Yes, I have. I believe I actually have a blog post on that. I can't remember where it is, but yes, I have tried it. That is not how I deal with getting in and out of strategies. I have a different method of determining when to get in and out of strategies, in a sense. And I don't like using the equity curve. I don't know. To me, it's just another parameter that you're tweaking on a strategy. And the more parameters you add to a strategy, the more likely it's going to get overfit. And to me, I know a lot of people that do, a lot of traders that use the either moving average on the equity curve. I got a good research friend that I know that uses a standard deviation of like the linear regression on the line, or something like that. So there are different ways of doing it. Not my way. Like I said, I use a different way of doing things.
Yeah. Got a good question here from BK, actually. I'm interested to hear what you think about this one. Do you ever test performance approaching monthly option expiry or just after?
I haven't. And actually, that's a surprising, for mean reversion strategy, that might be interesting to try. One thing, you definitely going to reduce your samples. You're going to have a much smaller sample size. But if you got a good active mean reversion strategy, that might be possible to. Yeah, it would definitely be possible to do. I have not tried that, and that's actually quite surprised. I've not tried that idea.
Well, that adds a whole new angle
on my research list.
Yeah, it adds a whole new angle, right? Because if you think about calendar events or perhaps seasonality, they can all have different impacts on the markets. So perhaps there's some good opportunities there as well.
Right. I mean, often this question is asked about earnings, and the problem with earnings is getting the data for it. But monthly option expiration, that's no problem getting the data for that. So that is an interesting idea. Like I said, I'm definitely going to put that on my hugely long research list of things to test.
And always expanding, right?
Yeah, always expanding much faster than I can get to things.
Now we have a question here from Hope. It's kind of getting a little bit off topic, but I might just raise it, and if you don't want to answer it here, that's fine. So it's your choice. Hope's question should be coming up now. What do you think of Markowitz's model to manage multiple strategy portfolios?
Okay, I'm going to sound like an idiot now. I'm not sure what the Markowitz model is. Do you know what he's talking about? Or?
No, it's too much, I think, to go into right now. So
okay, sorry, I'm not familiar with that model.
That's okay. All right, so I think we're going to start finishing up soon. I think I've caught most of the questions there. If you've got a late question, quickly put them in the chat now. Cesar, you had some extra slides at the end of that, I think, that you wanted to share.
Yeah, just a couple of quick things for people here.
You want to share your screen, and I'll flick over to...
All righty. So a couple of slides here. So I've got, for those of you aware, I've got my own private trading club at tranquilitytrading.com. So if you go there and use coupon code BST regime, they'll get you 10% off. It's good to the end of the month. So anybody who's been listening, that's definitely a great way to learn more about my strategies, get more in contact with me. Like I said, it's a private trading group. It's a small group of people, active traders. Olaf, who was asking some great questions as part of that group. And then again, if you want to contact me, here's my email. If you got any questions, definitely feel free to shoot me an email. I love talking to other traders. No question is a bad question. All questions are fun questions. And if I don't know something, I will say I don't know. Like I just said on the Markowitz question, I have no idea what that is, what that particular method is. But if I do know, I try to be kind of open and honest and truthful, and try to give people good information.
Yep. And also, there's plenty of good information on your website. So that is alvarezquanttrading.com. I know that a lot of the things that we've talked about today, you've published research on there. So if people want more info, I recommend they go and check that out. There's lots of good stuff there. You even have code and charts and all kinds of things. So thank you very much for joining us today, Cesar. You're very always very forthcoming with your knowledge and your insights. Is there anything else you wanted to mention before we finish up? Any last words?
No, I just want to thank you again for having me on, Andrew. You have a great podcast, and now it's going to be live. I was really sad, and when you hadn't done anything for a year, and was completely thrilled when I heard that you were coming back up, because you always have really good guests, and I always learn stuff from your guests and get trading ideas. A couple of your guests have, actually one of your guests gave me, I believe it was one of your guests, gave me some thoughts about my market barometer on how I built that. So, definitely going to be looking forward to this, and hopefully be on again. Got a whole bunch of other things we can talk about.
Yep, excellent. I've got a final question here from M. Nunez about regime opinions on today's markets, which I think we already covered, right? So,
I can show you here. Let's take a quick. Let me share my screen real quick.
Yep. All right.
Just so we can.
There we go.
Yeah. So we can take a look at here. We can look at AMI broker right now. You can see right now all three market regime filters are green, and the market barometer is in bullish. So right now, they're all still happy. Even though we've had a sell-off, we are all four are still in the happy mode. And I'm not changing anything until they start telling me to change something.
Yeah. Well, it could be interesting to see what happens over the next a couple of months and perhaps even years. So we've had a good run. Yes. We'll see how long it lasts.
Yes.
Anyway, thank you again, Cesar, for joining us today. It was really great, and we've got a lot of good feedback actually in the chat here. So I might just share a couple with you to finish on a high note. So Suvadeep wants to thank you for such a wonderful session.
Thank you, Suvadeep.
Aru says, thanks.
It's been an honor talking to you guys.
Yeah. And a lot of people are happy to join. So actually, it was really good of people to come along today and post questions. And I can see there's a lot of great discussions going on in the chat. So thank you to everyone for joining us. And also now, if you liked the what we did today, please make sure that you like and subscribe to the YouTube channel. We've got a lot of great guests coming up. I'm actually almost booked to the end of the year already now. So
wow.
We've got a lot of good guests and a lot of great topics. So make sure that you subscribe to YouTube, then you'll see all the new events popping up and the topics, and you make sure you don't miss that. And also, if I can just ask you to share this with all your trading buddies, and we want to try and impact as many traders as we can. We've got some great content, so they shouldn't miss out either. So please tell everybody, all the traders anyway, get them all to come along. So next week,
get them on.
Yeah, exactly. Yeah. So this will be available as a recording. If I see that a couple of people joined in late, you will be able to watch it pretty soon. Actually, the recording will be available. Now, next week, we've got a guest, Nick Raj from The Chartist. He's going to be talking about diversification, which should be a good one. He's got some tips on how he implements diversification across many different ways in his portfolio. So that should be good. It's the same day and same time. So please make sure you don't miss that one. And thanks again. Have a great week. Cheers, Cesar, and cheers, everyone.
Thank you so much.
Bye.